US Treasury Secretary Scott Bessent recently criticised China for having the most unbalanced economy in the history of the world. Ominously, he said China cannot be allowed to export their way back to prosperity. And the US is doing their best to upend the global trading system and make it difficult for China in particular. In 2025, US tariffs on China have gone from 0 to 30 to 145 and back down to 30, and that's called a tariff holiday. There is an idea that Trump changes his mind and never really implements tariffs, but that is not true. The average tariff rate is going up. As of July the 14th, 2025, the Yale Budget Lab estimate the average US tariff rate is 20.6%. That's the highest level since the 1930s. Even one of the very few trading agreements with Britain involved tariffs of 10%. The age of free trade is over. It's a seismic shift in the global economy. In the past 50 years, global poverty rates have plummeted. But in a recent report, the World Bank warned that the conditions which led to prosperity have now swung into reverse, and it will be the poorest countries who suffer the most. Global growth rates have been falling for decades, but what does the future hold now? 2025 will be one of those seismic changes in the global economy, comparable to the tariff shock of 1932, the oil price shock of 1973, or the end of the post-war consensus around the early 1980s. But whilst America is looking back in time to the 1950s, when the US had 17 million manufacturing jobs, China is looking to the future with the next generation of industrial production. In the 80s and 90s, China dominated through cheap, abundant labour. But in the coming decade, China is looking to dominate through a revolutionary, artificial intelligence, automised production. For example, Chinese tech giant Xiaomi has recently launched a fully autonomous, smart factory capable of manufacturing 10 million handsets annually. The factory operates 24 hours a day without even the need for human operatives to oversee problems. Not only that, but there's the continuous search to improve and automise production even further. And China is bringing unprecedented economies of scale, government support, and a culture of firms who are motivated not so much by profit margins, but the goal of Naijuan, the never-ending goal to outcompete and gain market share with a relentless focus on cutting prices. Already China is slipping into deflation, and they're exporting electric cars which obliterate European and American rivals in terms of price. BYD's lowest car sells in China for under $8,000. The cheapest electric car in the UK is much more than double that. Now, in the new tariff regime, US firms may eventually reshore some of the production back to the United States. But don't expect a new surge in manufacturing jobs. The new automated production style will eventually come in everywhere. The strength of the US economy will not be in manufacturing so much its own high-tech AI industries. But the big question is, will tariffs derail Chinese exports and the Chinese economy? The US is China's biggest export market, $525 billion of exports in 2024. But still, that only accounts for 14% of Chinese exports, down from 20% in 2017. US tariffs alone will not end the Chinese economic model. The US is declining as a share of global GDP, and the emerging economies, the BRICS economies, are ready to take on China's cheap exports. The next 50 years will also see the emergence of Africa. It will be one of the few places with an expanding working age population. The rest of the world is pretty much in decline. So far, despite a 16% fall in exports to the US, China's economy has been resilient, and overall exports are reaching record levels. Now, China certainly has its own economic problems. Scott Bessent may exaggerate, but the Chinese economy is unbalanced, with domestic consumption too low, housing debt a real problem, and their own ageing population. But after the last round of tariffs, Chinese firms just shifted final production to other countries. Never underestimate the capacity of firms to get around tariffs. The big story is that in the 90s and early 2000s, China exported low inflation. With falling industrial prices, they may be doing the same in the next decade too. If Europe really wants to transition to a green economy for minimal cost, the price will be importing a lot more from China. But the change in the global economy is more than just tariffs. 2025 marks the beginning of a decline of the dollar's dominance. The dollar is falling this year for many reasons: less confidence in the US, concerns over debt and their attitude to bondholders. So even as US bond yields rise, investors are still selling dollar assets. And it's not just about the fall in the value of the dollar. Less trade will be conducted in the dollar, less foreign currency held in dollars, less invoicing in the dollar, and there'll be no clear alternative. Now, what happens as the dollar loses its dominant position? Martin Sandbu in the FT warns about a frightening world without the dollar as a dominant currency. Firstly, international trade will become more risky and expensive, but perhaps the biggest shock to the global financial system will be if the world loses the US Treasury as a globally recognised safe asset. Currently, a US Treasury is seen as so safe and stable it could be considered near money. It's highly liquid. But investors look at projections for US debt and worry that given political dysfunction, this could easily end in a debt crisis, either increased money supply and inflation or financial controls. Even if this was to be a possibility, the global financial system would lose one of the factors that would undermine financial stability, and it would have huge implications, notably higher interest rates, lower growth and less investment, trade, credit and liquidity would all be more costly. Now, the huge shock of America's unorthodox economic policies is pushing Europe out of its comfort zone. In the past decade, the US economy has significantly outperformed Europe. Europe has become somewhat sclerotic with low growth, high regulation, low investment. But with Trump cutting back defence commitments in Europe and threatening tariffs of 30%, Europe is kind of being pushed to reinvent itself. The threat of US global retreat could be the making of the new European economy. But the fate of Europe remains a big unknown. Can it really reinvent itself as its population ages and gets weighed down by pension commitments and things like that? Now, the US is not alone in having a dramatic debt trajectory. The world is seeing a rise in government debt around the world, basically because the world is aging rapidly. Japan was the first country to see peak population. Its population is now in decline. One reason, by the way, for its government debt of 260% of GDP. But 2025 has also been the year when Japan has seen a sharp rise in the cost of borrowing after decades of ultra-low interest rates. This raises the spectre of much higher debt interest payments. It will also encourage Japanese investors to sell their 1 trillion holdings of US debt and buy Japanese debt instead. The Japanese carry trade is over, and that means a sell-off of global assets. And it won't just be Japan. Europe is in a similar position. The UK, which has a decade of relative decline, has experienced its own deterioration in its financial prospects. But the UK also shows how difficult it is to deal with a dynamic of low economic growth and rising debt at the same time. Voters around the world are fed up and they don't want to see their pension benefits cut, even if they're not particularly affordable in the long term. And that is another shock facing the global economy. Advanced economies are slowing down. Rates of growth have been falling for decades. And generally, as your population ages, you can expect lower investment, lower dynamism, and that creates a negative feedback cycle for debt and growth. And this will probably be greater than any tariff effect. Now, if that wasn't enough, the world doesn't just face a new economic climate, but literally a different weather climate too. The world is warming up, creating more extreme weather events. Insurers and actuaries are fully aware of the potential implications, even if politicians are not so keen on the topic. This report suggests that under current policies, the world could see a 33% loss of GDP from the impact of volatile and unpredictable climate in the next few decades. Now, you'll be relieved to know it's a mistake to focus only on the pessimistic scenarios. Technological progress shows no sign of slowing. There's been a global surge in the installation of solar panels. AI is improving. The continuous progress in cutting costs is perfectly suited to renewable energy and battery technology, where we're seeing 20% improvements every year. We've also seen a huge range of innovations from farming to transport to manufacturing. And whilst we worry about a shrinking working population, we're also developing increasingly humanoid robots which have the capacity to potentially move into areas like healthcare and care workers. And even if we do get a degree of deglobalization, we won't be turning the clock back a century. Industry, companies are still too global. And what may happen more likely is a growth of regional trading blocs. Also, whilst everyone assumes that America has permanently changed, it is actually quite possible that tariff roller coaster could be ended by the courts, Congress, or future elections. And if the US is less dominant in the global economy, so be it. Economic empires always rise and fall. Just over 100 years ago, the UK was the largest economy in the world, but who misses Britain's dominance today? But perhaps the biggest shock to the economy will not come from tariffs, technology, or global warming, but the most important commodity of all, people. We just don't want to have kids anymore, and the population is set to fall, slowly at first, but then dramatically. This video looks at what happens next.